Welcome to the Deep Dive, your shortcut to being genuinely well-informed. We all know that classic investing mantra, right? Buy low, sell high.
Everyone's heard it.
Yeah, it's everywhere. But knowing it, that's one thing. Actually doing it, consistently, effectively, especially when the market's tanking and the news is all doom and gloom.
That's the real test.
Exactly. That's the challenge. So today, we're doing a deep dive into our sources, not just to repeat that old wisdom, but to really dissect how the successful investors managed to turn these market downturns into, well, massive wealth-building opportunities. It's about using those moments when everyone else is, pretty understandably, running for the hills.
Right. Leveraging the fear.
So the standard thinking, the thing most people do, is jump in when everything looks great, prices are up, everyone's excited, it feels safe almost.
Yeah, the classic FOMO effect. Fear of missing out.
Right. The market's booming, people are making money, and that fear of missing out just pushes prices higher and higher. It feels like the right move, following the crowd when things seem good.
Seems logical on the surface.
Okay, but let's unpack this a bit, because what our sources are telling us is that actually the real magic, the real wealth creation, often happens when things look absolutely terrible. When the market's in free fall, prices crash, and, fear is just everywhere. It's not just counterintuitive, it's like a deep psychological game. And if you win it, well, it can totally change your financial future.
And what's fascinating there is exactly that psychological piece. I mean, the buy low idea is simple enough to grasp intellectually,
Sure.
but acting on it, that takes something almost superhuman, going against our basic instincts. Our sources really emphasize that these downturns aren't just economic blips. There are times when the market fundamentally gets asset prices wrong because panic takes over. Emotional selling is rampant.
So it's not about avoiding risk entirely.
No, not at all. It's about seeing when the reward for taking on the risk of holding good assets gets incredibly high. That's, as our sources put it, when the best deals show up. So this deep dive is really about spotting those moments, understanding why they happen, and, crucially, getting ready both with your money and your mindset to actually act on them.
Absolutely. So yeah, over the next few minutes, we're going to peel back the layers on how these opportunities aren't just random. They're kind of created by market psychology. We'll look at patterns the sources point to, what you absolutely need to grab these chances, and we'll even bring in some wisdom from, well, the greatest investor of all time. So get ready to maybe rethink how you look at market swings.
Should be interesting. Okay, let's dive right into this counterintuitive idea. When fear equals fortune, we know the saying, but why is it so darn hard to follow? Our sources confirm, yeah, most people buy when markets are high, greed is everywhere, driven by that herd instinct.
But they also state really clearly that the best time to build serious wealth is precisely when things look bad, the market's down, prices crash. It's like flipping popular thinking on its head, and very few people manage it consistently.
And it's not just like a preference, it's almost a strategic requirement if you really want to outperform the average. What's truly fascinating here, and our sources go deep on this, is the mix of behavioral biases that stop most folks from acting logically during these downturns.
Okay, tell us more about that.
Well, when markets are flying high, that herd mentality is powerful.
Yeah.
Everyone wants in, they're scared of missing easy money. That's the FOMO we mentioned.
Right.
It pushes prices way beyond what they're probably worth. But then when things turn and when everyone else is scared, a whole different set of biases kicks in, just as strong.
Like what?
We're talking about things like loss aversion. Psychologically, losing money hurts roughly twice as much as gaining the same amount feels good.
Wow, twice as much.
Yeah, which is why people panic sell right at the bottom, locking in those losses, even if they own really good quality stuff. Then you've got the availability heuristic, all the scary headlines, the negative news everywhere. It makes the future seem way worse than it probably is, and it just drowns out any calm analysis. These mental traps basically cause assets to be mispriced systemically. That's the window for the contrarian investor. Our sources aren't just saying buy low, they're explaining why these low points happen. It's baked into human nature.
Got it. So it's not just resisting the urge to buy high, but actually leaning into the discomfort when things look bad. That's a huge challenge to our basic instinct to follow the crowd, isn't it?
It really is.
It means consciously fighting these really strong emotional pulls that tell us what feels safe and what feels risky, recognizing that the perception of risk often peaks exactly when the potential for future returns is highest, and the other way around, too. Okay, here's where it gets really interesting. Our sources use this fantastic analogy. It makes it super relatable if you like a bargain. They say you should think of market crashes like Black Friday for investing.
Yeah, I love that analogy.
Me too. But it's not just a catchy phrase, right? It speaks to the scale of the opportunity.
It's incredibly fitting, and our sources definitely unpack it. It helps you immediately grasp the kind of discounts we might be talking about. During these big downturns, you're not just looking at like 5% off.
No.
You're looking at quality assets. Stocks and real estate, for example, can be 20% off or more, sometimes much more. But, and this is critical, the research we looked at stresses distinguishing a true bargain from a value trap. Something that's cheap for a good reason.
Right, like a fundamentally broken company.
Exactly. The real opportunity is in buying fundamentally sound things, solid companies, good properties in good locations that are just temporarily dragged down by the overall panic, not because they're permanently damaged. Think back, like the dot-com bust. Some tech companies that are giants today were trading for pennies on the dollar back then.
Right.
Or 2008, the financial crisis. Huge entry points in banking, real estate for those who had the nerve and the cash. Even that quick, sharp drop in early 2020 with COVID, that was a short window. But wow, some blue chip stocks were suddenly on sale. These aren't just minor sales, they're like clearance events for great assets. The sources really hammer home that recognizing these periods of mean reversion, this tendency for prices to snap back towards their fair value after going too far down, that's key.
Exactly. And it's not just saving money up front. It's setting yourself up for way bigger long-term gains.
Right.
I mean, imagine buying an asset at 30% or 40% off compared to someone who bought at the peak.
Yeah, the difference is huge.
It totally changes the math on your wealth building. You get this much lower cost basis, and every bit of future growth is magnified. That's the difference between just, growing your wealth steadily and really accelerating it. Okay, so if these Black Friday deals are so amazing, why isn't everyone jumping on them? Our sources are super clear. Spotting the sale is only half the equation. There are two absolutely essential things you need lined up way before the crash happens to actually take advantage.
You nailed it. That's the gap, isn't it? Between seeing a sale and actually buying something. The first, the most important requirement our sources highlight is having cash ready, or dry powder, as some call it.
Right, dry powder.
They state it flat out. But only people who have cash ready can buy them. Without liquid money ready to go, even the most incredible deals, the biggest discounts on great assets, they're just unavailable to you. You can see it, understand it, but you're stuck on the sidelines.
Frustrating.
Very. And building this dry powder isn't just like keeping cash under the mattress. Our sources talk about different ways, maybe high-yield savings, short-term T-bills, money market funds. The tricky part, though, is the psychology again.
Holding cash when markets are soaring?
Yeah, it feels like you're missing out. You worry about inflation eating it away. You see others making easy money. It's tough. But the disciplined investor, as our sources frame it, understands that the opportunity cost of not having cash for those rare big downturns is way, way higher than the small loss from inflation during boom times. It's about strategic patience.
That's a really key distinction. The patience to hold cash when everyone else is chasing gains. But just having the money isn't the whole story, is it? Our sources stress there's a second piece just as vital.
Precisely. And this is where a lot of people who try to be opportunistic fall down. Our sources say not only do they need to have cash ready, but they also need to have a strategy in place. It's not about panic buying or just grabbing anything that looks cheap.
Okay.
It has to be informed, deliberate buying, guided by a plan you made beforehand, like the example given. If they're investing in stocks, they need to know what strategy works for them so that they can capitalize on opportunities.
So what does that strategy look like?
Well, it should include specific rule for what triggers a buy.
Wow.
Are you a value investor?
Right.
Maybe you're looking for companies below a certain PE ratio or below book value or based on discounted cash flow analysis.
Right.
Or maybe you prefer dollar cost averaging, deploying your cash in stages as the market falls to get a better average price. Or are you targeting specific industries that you think are oversold but have good long-term prospects? The point our sources make is you need this shopping list and your buy points defined before the panic hits. That way, you take emotion out of it as much as possible. You know what you want to buy and roughly at what price. So when fear grips the market, you're executing your plan, not just reacting to the noise.
That difference between just having cash and having a well-defined, pre-planned strategy,
Yeah,
that seems absolutely crucial.
it is.
It means this isn't about luck or being quick on the draw. It's about preparing proactively with discipline, being ready not just to react, but to actually use the market conditions strategically when they appear. Having that detailed game plan, your shopping list, your price targets, all ready to go before the Black Friday sale even starts.
Exactly right.
And our sources really drive this home with wisdom from, well, arguably, the greatest investor of all time, Warren Buffett. It's a quote we've all heard, maybe so much it sounds like a cliche, but the real depth, the practical meaning, sometimes gets lost. He tells us, be fearful when others are greedy, and be greedy when others are fearful.
Yeah, and if we tie that back to everything we've discussed, that one sentence really sums up the whole philosophy of buying good stuff cheap when everyone else is panicking.
Right.
When Buffett says, be fearful when others are greedy, he's talking about those times we mentioned. Markets are high, valuations look crazy, everyone's irrationally optimistic. That's when you should be careful. Maybe trim positions, take some profits, or just sit tight on your dry powder. It's about seeing that the risk of a correction is probably pretty high then.
Okay, that part makes sense. Be cautious when everyone else is euphoric.
Then comes the harder part.
Yeah.
And be greedy when others are fearful. This hits right at the core of seizing opportunities in downturns. When the market is crashing, fear is everywhere, people are dumping perfectly good assets because they're scared.
Yeah.
That's when you, with your cash ready and your strategy clear, get to be greedy. Now, greedy doesn't mean reckless. It means having the confidence to buy valuable assets when they're marked down significantly, because you understand the market tends to recover long term, even if it looks terrifying short term. It takes guts, conviction, and being able to see past the screaming headlines.
It's a complete mindset flip, isn't it? It demands you consistently swim against the tide, against your own gut feelings sometimes. It's not just about knowing finance, it's about mastering your own psychology and having the discipline to step back when emotions are high and then step forward decisively when others are running away. So, what does this all mean for you, the listener, as you think about your own approach? It's about really internalizing this paradox and maybe building the systems to act on it.
Yeah, building the discipline.
So let's quickly recap our deep dive for you today. We've really dug into this counterintuitive but incredibly powerful idea about market downturns. We've seen how our sources frame them not just as threats, but as real significant opportunities, kind of like those Black Friday sales for smart investors. And crucially, we've highlighted those two essential ingredients: having the cash ready, that strategic dry powder, and having a clear, predefined investment strategy so you can actually act effectively. And all of this really echoes Warren Buffett's timeless advice. Be fearful when others are greedy, and greedy when they're fearful.
And maybe this raises a final important question for you to think about, something that goes beyond just this deep dive. Beyond just saving up the money, how are you actively preparing your mindset right now?
Interesting.
Are you building that emotional resilience, that sort of detached view, the contrarian thinking you need to see past the immediate panic? How can you train yourself to be patient holding cash when it feels unproductive and then act decisively when volatility hits? It's really a question of foresight, psychological prep, and ongoing discipline, not just reacting when things happen.
That's a fantastic thought to chew on and really gets to the deeper lesson from our sources, doesn't it?
I think so.
Well, thank you for joining us on this deep dive. We definitely encourage you to reflect on your own readiness, both financially and, maybe more importantly, psychologically, for these unique, powerful market moments. Until next time, keep digging deeper.